Welcome back to Daily Digests for July 27th, 2026. Today, the market is navigating intense pre-earnings tension as mega-cap tech companies prepare to report second quarter results. Futures index volatility is elevated as investors weigh two converging forces: seller-side vendor financing loops sustaining AI hardware purchasing, and a surprising resurgence in bond yields, pricing in a non-zero chance of a Fed rate hike. Our top development today comes from Chinese macro reporting and supply chain disclosures surrounding NVIDIA. Analysts confirm NVIDIA has structured over $10 billion in cumulative circular vendor financing. This includes $5 billion in credit guarantees for customer data centers and $5 billion in chip procurement facilities, ensuring buyers can continue placing GPU orders despite tightening corporate budgets. At the same time, macro interest rate pressures are resurfacing. CME FedWatch data now reflects a 37.9% probability of a rate hike at this Wednesday's FOMC meeting, up sharply from single digits last month. The 10-year Treasury yield has pushed back toward 4.7%, driven by persistent inflation metrics and energy cost volatility. Higher discount rates directly compress high multiple growth equities. This interest rate backdrop sets a critical test for big tech earnings this week, led by Meta and Microsoft on Wednesday. Wall Street is no longer giving companies a pass for rising capital expenditures. Investors demand clear line-of-sight revenue conversion to justify elevated valuations, making quarterly margin guidance the primary determinant of post-earnings price action. In corporate leadership news, Apple has finalized its executive succession plan. John Ternus, Senior Vice President of Hardware Engineering, will officially succeed Tim Cook as CEO on September 1st, while Cook transitions to Executive Chairman. Apple's capital discipline, spending roughly $1 billion on AI capex compared to over $1 billion for peer hyperscalers, highlights its strategy to focus on edge AI, integrated directly into custom device silicon. Meanwhile, Meta is exploring new revenue avenues to monetize its massive infrastructure investments. Reports indicate Meta is in advanced talks with Anthropic for $1 billion compute leasing agreement over 2 years. With Meta's 2026 capex guidance raised to between billion and billion, leasing excess data center capacity allows Meta to offset infrastructure costs while building a cloud services business. Beyond technology, strategic defense policy is undergoing a structural shift. Analysis from the Hoover Institution emphasizes that the proliferation of low-cost, high-precision drone systems across more than 90 nations is dismantling traditional military doctrines reliant on heavy mass. Defense procurement is pivoting toward mass-produced, expendable systems, creating long-term tailwinds for specialized defense technology contractors. In equity flows, congressional trading disclosures reveal multi-year high accumulation in MasterCard and S&P Global. Institutional investors and corporate insiders are positioning for agentic commerce, where autonomous AI software agents execute financial transactions directly, requiring established high-security payment rails to process autonomous trade volume. Underneath headline index movements, capital is actively rotating across sectors. Money flows are moving out of high-multiple technology stocks into cash-generated utilities, regional financials, and materials. Atmos Energy generated an early technical breakout signal today, supported by strong balance sheet fundamentals and steady earnings visibility during volatile rate environments. In the semiconductor supply chain, SK Hynix reported that a growing majority of its high-bandwidth memory capacity for next-generation AI chips is secured under multi-year long-term agreements. These binding forward contracts help stabilize memory pricing and protect gross margins against cyclical spot market fluctuations. On the technical charts, the S&P 500 is testing critical short-term moving average support levels. Systematic funds and commodity trading advisors have tightened stop-loss triggers following recent leverage flushes, keeping market breadth constrained until earnings results provide fresh directional clarity. For portfolio risk management, managing discount rate exposure is paramount. High capital intensity trades require rigorous scrutiny of balance sheet debt structures and customer financing loops. Balancing growth exposure with defensive dividend compounders provides a necessary buffer against near-term macro volatility. To summarize July 27th, NVIDIA's billion vendor financing strategy highlights the lengths to which hardware leaders will go to support customer demand. As FOMC rate hike risks converge with mega-cap tech earnings, sector rotation towards stable cash flows remains the dominant market theme. Thank you for tuning in, and we will see you tomorrow.